Hello, my name is Rachel Vahey. I'm a Senior Technical Consultant at AJ Bell. I want to talk to you today about one of the most important tax rules for pensions, the lifetime allowance. Our learning objectives today are to understand the basics of how the lifetime allowance works and how the lifetime allowance charges are applied. I want to discuss the freezing of the lifetime allowance and what effect this is going to have on your clients. And related to that, I want to discuss some of the problems which are thrown up by the lifetime allowance and the different approaches clients can take to mitigate their charges. So let's start with the basics. To encourage people to save for later life, the government offers fantastic tax advantages to those saving within a pension. However, to stop people from abusing these tax advantages, the government also puts in place two checks on pension savings. One on the way in on the amount you save, and the other, the lifetime allowance, on the amount that you can take out of a pension. Now, people can take out as much money as they want from a pension, but there is a limit on how much you can take out tax efficiently. If they take out more than the lifetime allowance or more than their lifetime allowance, then a tax charge is going to apply on the excess. Every time a person takes money out of a pension, for example, on drawdown, when they designate drawdown or take a tax-free lump sum, or death, then the amount they take is tested against the lifetime allowance. And there are other occasions where there will be a test as well. For example, when someone reaches the age of 75 or when they transfer overseas. If someone uses up 100% of their lifetime allowance, then any further money they take out of their pension is going to be subject to a lifetime allowance charge. And we'll come back to that in a minute. The standard lifetime allowance is $1,073,100. However, some people are entitled to a larger lifetime allowance than that. When the lifetime allowance was originally introduced in 2006, it was 1.5 million. At that point, if someone had pension benefits which was worth more than 1.5 million, they could protect that value with either enhanced protection or primary protection. Over the last 10 years, the lifetime allowance has been cut 3 times. On each occasion, protection has been brought in to help people who've got benefits of more than the new lifetime allowance protect that value. We now have 7 different types of transitional protection, and some very complex and confusing rules to go alongside that. The lifetime allowance charge is either 55% or 25%, and it depends upon whether benefits are taken as a lump sum or whether they remain within the pension. Now, that partly depends upon the benefit crystallisation event, how you're taking the benefits. For example, the check at age 75, it will always be a 25% charge, and the funds will remain within the pension. The reason for the 2 different charges is because when you take the money out of the pension, the government is assuming that you're going to pay tax on it. And it is assuming that you're going to be paying tax at a rate of 40%. So if you look at these 3 rates, if you're looking at a 25% lifetime allowance charge plus 20% income tax, that's a 40% effective rate. For higher rate payers, it's a 55% effective rate, the same as if you took the money out as a lump sum. And if you're looking at an additional rate taxpayer, it's slightly more, it's 58.75%. A benefit crystallisation event is when the amount of money is tested against the lifetime allowance. There are 13 benefit crystallisation events in all. Unfortunately, they're not numbered 1 to 13. That would be far too simple and straightforward. And instead, new benefit crystallisation events have been shoehorned in when they have appeared. So, for example, under number 5, there are 6 different types of benefit crystallisation events. Now, I've listed these here very succinctly, but just to run through them. For scheme pensions, there are 2 benefit crystallisation events for when you're taking the pension, but when you're buying the scheme pension, and also if you have excessive increases in the scheme pension. For defined benefit schemes, to convert it into a monetary value, you take the value of the scheme pension and times it by 20. Now, it doesn't matter if there's indexation on the scheme pension, or if it's a spouse's pension attached to it, or if there's a guarantee period, or what those values are. It doesn't matter. It's a straight 20, regardless of the bells and whistles that go alongside that scheme pension. And it always has been a factor of 20 ever since the lifetime allowance was introduced in 2006. Sometimes the defined benefit scheme will pay a separate lump sum on retirement, and sometimes it's commuted from the value of the pension. If it's a separate lump sum, then it will be counted as BCE number 6. And if it's commuted, then you just count the value of the starting pension before it's reduced. There are benefit crystallization events when someone takes the money from a defined contribution plan. For example, they buy an annuity, or they designate it to drawdown, or they take a PCLS. With these, you take the monetary value of the pension fund and compare it against the lifetime allowance. There was a worry that people would just try to get around the benefit crystallization event test by not taking benefits at all. So for that case, there is a test at age 75 just to stop that. So there are 2 tests for defined benefit and defined contribution pensions that have not yet been taken. But there is also a test for drawdown at age 75, and I'm going to cover that in the next slide. There are 3 benefit crystallization events relating to death benefits. One is a lump sum, and the other 2 are testing benefits, again, that haven't been tested yet, which haven't been taken. So it's just to make sure that all benefits are tested at some point. And there's a test when someone moves abroad and moves overseas out of the UK sphere. And then there is a final benefit crystallization event, which covers some miscellaneous things, miscellaneous items. I said I would come back to the second drawdown benefit crystallization event. HMRC was worried that people would move to drawdown soon after age 55 and have a benefit crystallization event test, but then not take any income, but enjoy full investment growth on their benefits and end up with a much bigger fund that isn't tested against the lifetime allowance. So the benefit crystallization event 5A is there to test the growth on the drawdown fund against the lifetime allowance at age 75. If someone has been taking income from their drawdown fund, then, and it's now smaller than it was originally when it was designated into drawdown, then there isn't a test. It's only if the drawdown fund at age 75 is bigger than that originally designated. In that case, you're testing the investment growth. Each tranche of drawdown is tested separately on its own. So if you have 2 different tranches of drawdown, one has positive investment growth and the other doesn't, but overall, looking at them, there is a smaller total drawdown fund at age 75. That doesn't matter, the overall position, because one tranche has positive investment growth, then there is a benefit crystallization event and some lifetime allowance will be used up. So the lifetime allowance has been in the news recently. It has been frozen. So let's have a look at exactly what's been happening. Now, these figures are taken from HMRC statistics, and these particular figures were released in June 2021. They're still running a little bit behind time, as you can see, because the tax years they're referring to only go up to 2018. You can see that over the last few years, there has been a significant increase in the number of people paying lifetime allowance charges and the total value of lifetime allowance charges being paid. When lifetime allowance was first introduced in 2006, there was a lot of chat about fat cats and not very many people being subject to the lifetime allowance. And I think what this graph demonstrates more than anything is that that's simply not the case. Many more people are affected by the lifetime allowance, and a good number of your clients will be. And it needs some planning to figure out what's going to happen and what's the best scenario and the best decisions to take. We had a budget in early March, but even before that date, we had leaks in the press about the lifetime allowance and the fact it was going to be frozen. Some of these headlines, though, I think are slightly incorrect. For example, I don't think it's a tax raid really on pensioners. It will affect those people who are taking drawdown because of the age 75 test, there is no doubt. But I think the effect of freezing the lifetime allowance isn't really the preserve of the pensioner age bracket. I think it affects many more people than that. It's going to affect those who are both approaching taking retirement income, but I think it does stretch across a spectrum of ages. For example, those people in their 40s and 50s who have built up a decent sized pension, they have to now start to factor in the lifetime allowance freeze when they're thinking about what benefits they're going to take and what they want to contribute as well. If you take the example of a 50-year-old who's got a £500,000 pension fund, and they make £500 a month, £500,000 pension fund, and they make £500 a month pension contributions, if they enjoyed 8% investment growth, then they would hit the lifetime allowance by their 61st birthday, so fairly quickly. So it does affect all ages, but there is no doubt the people who are going to be hardest hit by the freezing of the lifetime allowance are those who are currently approaching retirement, as well as those who are taking income drawdown, or rather they are in drawdown but not taking much income, and they're going to have their investment growth tested. So I wanted to look at what would happen to those people. But before we do that, let's get out the crystal ball, do a little bit of gazing and to think about what's going to happen from 26, 27. We know that the lifetime allowance is going to be frozen up to that point. I think there are a few scenarios that could happen. It could stay frozen and just remain at 1,073,100. It could fall further, or it could start to inch up in line with inflation again and start to inch up very, very gradually. I don't think any of us are going to put any bets on it actually increasing by a big chunk. I don't think the lifetime allowance is going to increase by any significant margin over the next decade. So I think really those may be our choices. But whatever you think is going to happen, you need to start to factor into your cash flow models and to start working on that basis. And I think as long as you have a good idea and you explain your reasoning, then that's the most appropriate course to take. Of course, it could be something completely different to the three scenarios I've outlined. People have suggested that it may even fall before 2026, 27. And I think that might be the case. There's a lot of lip service being paid to the idea that we're going to see some changes to pensions tax relief over the next few years. But actually, in truth, it's really quite a difficult thing for the government to pull off, especially for defined benefit schemes. But they may not want to just cut defined benefit schemes out of the equation, because that is where they're going to get the biggest cost saving if they move to a single rate of tax relief. But it's also arguably where they get the biggest pushback as well, say from public sector schemes whose members don't really want to see a fall in their tax relief on their pension contributions. So rather than tackling this very thorny subject and trying to find a way through, the government may find it much easier just to pull on established levers that they already have at their disposal. For example, the annual allowance and the lifetime allowance. So even though they've frozen this as a first step, they may decide to reduce it later on. We have a budget at the end of August, end of October, on the 27th of October. So maybe we'll see what happens at that time. Okay, so I wanted to look, as lifetime allowance has become a bigger part of clients' lives, I wanted to examine the bigger role that it is playing within pension planning. I've got two scenarios to go through today. One is to look at people who are approaching retirement and whether they should carry on contributing or whether they should stop funding if they think they're going to hit the lifetime allowance. The other is people who are probably more likely and closer to taking benefits. And it's this question of, should they crystallise now, pay the lifetime allowance charge now, and then just leave their money, invest and leave their money? And then they could even take action to mitigate their charge at 75 by taking out income or something like that. Or are they better to forget all that and just let the money roll forward up to age 75 and then deal with a lifetime allowance at that particular moment in time? I think those are all very tough decisions for your clients. So let's explore them a little bit further. So let's look and start by looking at someone who is approaching the lifetime allowance and should they continue funding? Should they continue paying their pension contributions? Well, the plus side is they'll carry on receiving tax relief on their pension contributions. And if that's at 40% or 45%, then that's obviously a considerable benefit for them. And from that, they can compound that to enjoy compound tax-free growth, to enjoy a massive boost of their pension savings. They may also be receiving an employer contribution, and I think that's going to make a significant difference as well. Some employers, when approached about this issue and say, I'm worried about reaching the lifetime allowance, I'm not too sure I want to have my employer contribution, some employers may react by saying, well, we'll give you the remuneration in a different form. So you could take, say, a bigger salary or a bonus or whatever it may be. But other employers aren't as flexible as that. And some of them might just say, well, listen, that's the deal on the table, either take it or leave it, see what you want to do. And if that's the case, then it's probably just worth taking the pension contributions. The downside, of course, is that you're going to have to pay a lifetime allowance charge on in due course on the excess over the lifetime allowance when you take the benefits or when the person dies or when they reach age 75. And as we've already said, the charge is really 55% for higher rate taxpayers, whether you take it as a lump sum or whether you pay the 25% and then take 40% income tax into consideration as well. But the point with all of this is that the person gets to keep 45% of the excess. And maybe 45% of something is better than not getting any excess at all. So 45% of something is better than 100% of nothing. But it really just depends upon the cost to the client of getting that 45% of something. So let's run through an example. This is Jason. He is 58. He works for a manufacturing company. He earns £87,000 a year. He has a SIP worth £900,000. He contributes to his pension, so does his employer, and he wants to take his benefits in 7 years' time at the age of 65. Now, I am going to assume that the lifetime allowance remains frozen until 2025-26, and then it's going to increase by 2% for 3 years after that. And if that's the case, it could be worth £1,138,800 in 7 years' time. So should Jason continue funding? If he stops his and his employer contributions and he stops funding, then the current value of the SIP is going to increase up to £1,184,000 when he gets to age 65. Now, I've assumed 4% net growth for that over the next 7 years. You in your own calculations might want to take a different assumption and use a different assumption. Now, this is just over my estimated lifetime allowance. As you see, Jason is really quite close to the edge, and this is just over my estimated lifetime allowance. So Jason does have a charge to pay, and that reduces his SIP slightly to £1,173,000. And I think this already shows that Jason, in his current position where he's approaching retirement with a really quite a healthy SIP fund, he's the sort of person that is probably going to get caught by the freezing of the lifetime allowance. And where, you know, a few months ago, you might assume he would be okay. It just shows that now we know that the lifetime allowance is going to be frozen. He's more likely to have to pay a charge. If Jason decides to carry on funding, so his employer carries on paying in the contributions and Jason carries on paying in the contributions, then at 65, in 7 years' time, his SIP could be worth over £2 million. Now, again, I've assumed 4% net growth and 3% salary increases. I think it's quite difficult at the moment to figure out what your assumptions are, but those are the ones I've gone for. You may disagree and want to use different assumptions. In this situation, there is definitely going to be an excess. The lifetime allowance is well and truly bust. And he has got an excess of £884,000. We take a charge off that and it brings it down to a reduced amount of reduced SIP. Now, if we compare that between what he could have got when he was stopped funding and what he gets if he carries on funding, then it's a difference of £629,000. Now, of course, he's yet to pay income tax on that amount of money. So it's maybe not a very simple comparison, but he's yet to pay income tax on that. The cost to Jason for getting that extra money, that's extra £629,000 though, is 6% for 7 years, £40,000 gross, but if he gets tax relief, that reduces it down to £24,000. So that shows in that particular example, because it's such a good employer contribution, then it's probably worth contributing. But it will depend upon the size of the employer contribution and all the other factors that you take into consideration. What happens if your client has already got funds that are over the lifetime allowance, or what do they do then? How do they reduce their lifetime allowance charge? And what's the best strategy to take? Should they crystallise all their funds now and take the hit on the lifetime allowance charge? And then when they roll it up to 75, just take out income every year, just to keep it under that value, just to make sure that they don't have to take any further charge or any further hit on the lifetime allowance at age 75? Or are they better to keep the money invested and just let it all roll up to age 75 and then to work out what the situation is then? Obviously, there are pros and cons with both strategies, and it really does depend upon your client's personal circumstances, numerous factors, really what they want to do, what their objectives are, and what their needs are. If they crystallise at an earlier age, say 60, then they're going to face an immediate tax charge if they're over the lifetime allowance. And that's going to reduce the amount of funds that they've got, which could have enjoyed compound tax-free growth. If they do crystallise, then if they do crystallise, then should they take out their pension commencement lump sum, their tax-free cash? Do they need it? Lots of clients would obviously want their tax-free cash when they crystallise, but there is a question of whether they need it. What are the IHT implications? Will it just simply go into the estate? Will it cause an issue there? Could they gift it? Could they give it to someone else, or could they spend it? And again, what is the IHT, the inheritance tax implications of that? And what do they expect to live another 7 years? If they crystallise, then they can withdraw income as well, and they may want to withdraw income each year, as I said, just to keep them just bobbing under that benefit crystallisation event 5A, just to make sure they don't get any investment growth. But again, the same questions apply. What do they do with the income? Do they need it? Can they spend it? Do they want to? Will it just remain in the estate? Will it go into their bank account? Which doesn't seem to make an awful lot of sense. or can they gift it, and will their inheritance tax allowances could they do it within those confines? So there are lots of questions about this. They might want to maximise the pension that they pass on, and that might be a reason for not crystallising and not taking income out, but just letting the money roll up. And again, you need to think about how likely it is that the person is going to die before age 75 or after, because of the difference in the tax rules for income tax at that age. Maybe the best way to explore this is to run through a case study. Now, this is a case study for Ben. He's age 60. He has some income coming in. He has no lifetime allowance protection, and he has had a previous crystallisation event where he has used up 25%. Now, his previous crystallisation event was £200,000. He has a SIP value worth 1.35 million at the moment. He's got uncrystallised as 1.1 million, and his crystallised, his drawdown pot, is now worth £250,000. So the question is, what should Ben do? Should he leave his funds invested and take the hit at age 75 and not do anything with them? Or should he crystallise everything now, pay his lifetime allowance charge, and then try and avoid a second lifetime allowance charge at age 75? So should he crystallise everything and then just take income out just to keep him under that particular level? Let's see how both of these play out. So let's first of all, let's do some crystal ball gazing and figure out what Ben's lifetime allowance is going to be at 75, so 15 years in the future. Now it's 1,073,100. We're assuming it's going to be frozen for 4 years. I've again assumed 2% increases for the next 11, and you might want to do something completely different from that. Again, it's up to you to decide what's the best assumption for you. This works out at 1,334,300. I also worked out what it would be if it was just rolled up by 2% for 15 years, and that just shows how big a difference, even when we're just looking at assumptions and guesswork, it shows the effect of what the lifetime of freezing the lifetime allowance is going to be. £100,000 difference, which is, well, it's an awful lot of money in my book, and I'm sure it's an awful lot of money in many people's book. Okay, so these are the examples, and we're going to work them through. Now, there's quite a lot of figures, but I am positive that you will be fine with that, and we will get through this absolutely okay. So let's go. Right, the first option, route number one. Ben is going to leave his funds invested. So he's going to leave them crystallised up to age 75, and then he's going to look at the lifetime allowance then and do the calculations at that point. So he's not going to do anything with his uncrystallised fund. So it was 1,100,000, if you remember. You roll it forward to age 75, it's worth 1,981,000. And again, I've just used 4% growth. And again, you might want to use something slightly different. Now, if you remember, he's already had a crystallisation event. So he's already used up 25% of his lifetime allowance. He's got 75% still remaining. And if you take that of the lifetime allowance I worked out at age 75, then he's got remaining lifetime allowance left of 1,725,000. From that, he's going to take some cash, 250,000, and the rest, 750,000, is going to go into drawdown. His fund was worth 1.98 million, and the remaining lifetime allowance was roughly 1 million. So he is going to have an excess fund. And again, that's £980,000. And take the charge of 25% off that, and he's going to put the rest of it into drawdown. So that's £735,000. So his total drawdown fund at age 75 is roughly about 1.5 million. But he hasn't got any lifetime allowance left. So two key figures are really to pull out, I think. This is age 75, he's done nothing at age 60, he didn't need the money, he's left the money until age 75, and he's now got £250,000 cash, and he's got 1.5 million drawdown. He did have a £250,000 drawdown fund at age 60 as well. So I've looked at that as well, and we've rolled that forward up to 450,000, again, looking at 4% charge. Taken off 250, taken off the original 250 gives us another 250,000. Sorry, taken off the 200,000 gives us remaining 250,000. And again, he's got to look at that, but he's not got a lifetime allowance left. So his lifetime allowance charge is going to be 62,000, and that gives him 387,000 in his drawdown funds. So in summary, he's got 1.8 million drawdown, 250,000 cash, add them together gets you to £2,123,000. So that's leaving his funds invested, not doing anything with them, sorting it all out at age 75. The alternative, option 2, is that he crystallises at age 60, and then he does what he can not to pay a lifetime allowance charge. So this is an uncrystallised fund at 1.1 million. His available lifetime allowance is 75% of the current lifetime allowance, which is 1,073,000. And again, it's just taking cash and drawdown from that amount. He has an excess fund of 295,000. We take away a charge, we're left with £221,000 from his excess fund. And he hasn't got any remaining lifetime allowance. So that's at age 60. His total drawdown is 1,075,000. You have the £603,000, which he took from the lifetime allowance amount, the excess fund, and also the previous crystallisation, the previous little drawdown fund. He's taking income from that amount from over 15 years, and I've assumed he's going to take £45,000, and I'm assuming that the fund is going to increase by 4% a year. If he takes £45,000, then the fund at age 75 will be £1,025,000, which is the original benefit crystallisation events. That's the original amount put in. Now, I've assumed that that income is going to be taxed at 40%. I could be completely wrong. It could be, it will depend upon the client. It might be that it's 20%, or it might be that you manage to absorb some of it by personal allowances or whatever, however it works out. It depends upon other assets coming in as well. So in summary, for the second option, where he crystallises everything age 60, then you've got a benefit, a pension commencement lump sum, some drawdown funds, income over 15 years, and that gives you 1.6 million. So if you compare the two, there's actually quite a difference in this, but it is a very simplified example. And I think I was trying to illustrate a point. However, there is elements of tax you need to put in that. For the first option, everything is still invested within the pension and nothing has actually come out of the pension yet. So that's why it's not a direct read across both of those. So what's the best strategy and what's the best approach to take? Now, this is really just going to boil down to the client's personal circumstances, and there's a few factors that you and your clients may want to explore when you're coming to that answer. First of all, how likely it is that they're going to die before age 75. If they really don't think they are likely to live beyond age 75, then they may want to crystallise earlier, because any investment growth that they achieve between the date of crystallisation and death, they will be able to pass that on to their beneficiaries, and there won't be any further lifetime allowance checks. However, the majority of us probably can expect to live to beyond age 75. So it does depend upon the client and their own family history and their own medical history as well. When they take the money out, in the example we used for Ben, he was paying 40% tax, but as I said, he could be a 20% tax, or some of it within the personal allowance, bringing the effective tax rate down again. So it depends on what their own personal circumstances are. If they take the money out of the pension to mitigate the tax charge, so they're keen to take the money out, what are they actually going to do with that money? Is it going to sit in the estate? And if it sits in the estate, then it's may only add to inheritance tax complications. Can they gift the money? Do they expect to live for the next 7 years? I'm thinking about that. Who are they going to give the money to? Could they gift the money under normal expenditure rules as well? And that might be a solution if they could do that, and that way that they could mitigate the tax charge. What other sources of income do they have? And this will count, and this will put into play the thinking of not only the tax rates on withdrawals from the pension fund as well, but you also want to think about the order in which income from your assets can be taken. And sometimes it's better to use up other assets, for example, ISAs, which may be tax-free, and then leave the pension assets till much later and not try and extract the money from the pension assets. It just depends upon what other benefits they have and what other assets they have. And also, who are the potential beneficiaries? Who do they want to leave the money to? Do they want to leave the money? Some beneficiaries might find it more useful to have the money now rather than in 20 years' time or 30 years' time. By that point, they may not need the money as much. So sometimes there is benefits from extracting the money from the pension and giving it to somebody who actually needs it at this moment, rather than keeping it within the pension, rolling it all up, leaving it there, and then passing on a very healthy pension fund to somebody who maybe doesn't need it as much at that time of their lives. And of course, I looked at a very simple scenario there, and you know that that's so far from the truth. The wonderful thing about pension freedom is the flexibility it gives us. And I've just outlined here some of the possible options that you and your clients may want to consider. You can, of course, keep everything invested, but you could take out the cash, or you could crystallize up to the lifetime allowance, or you may want to phase crystallization as well. This isn't a one thing or the other, and it could be a set phased crystallization or a more of an ad hoc crystallization, depending upon income growth or depending investment growth, or depending upon income needs, or wherever the client is at whatever point in their life. They could crystallize but take no income. They could crystallize, take some, or as we explore, they could crystallize and take enough income just to avoid the lifetime allowance. This is a complicated subject, and unfortunately there's no silver bullet. There's no right or wrong answer for these particular dilemmas. You need to just think of it from the perspective of your client and to look at the key issues that they are affected by, and then to work through some scenarios. Take into consideration, though, what the freezing of the lifetime allowance has meant for your clients and what sort of effect it is going to have, and also what you think is going to happen in future with it. This presentation, this webinar, what we've done is we've run through the basics of how the lifetime allowances works, and hopefully you've just had a very brief reminder on that. I'm sure you knew that, and you knew how the lifetime allowance charge applies. We looked at the fact that the lifetime allowance has been frozen for the next 4 or 5 years, but also what's going to happen to it after that point, or do we think there may be, or do you think there may be a cut in the lifetime allowance before we get to 2025? And run through a couple of scenarios and a few of the problems. For example, whether people who are approaching the lifetime allowance to continue funding or paying in contributions which may depend upon what their employer contribution is and what their employer is willing to do for alternative remuneration packages. But we also looked at whether people should stay invested or whether they should crystallise. Looked at two simple scenarios, but as we finished off by saying, there's a whole spectrum of flexibility there for you to work with your clients to find the best solutions. I hope you found this interesting. I hope you found it useful. If you do have any questions, then please get in touch with us and enjoy the rest of your day. Goodbye.